Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. Well, it has been quite an eventful week where we have seen all kinds of data come in and various statements as well when it comes to the US and China trade talk. The latest really is that the Chinese officials have casted a doubt over possibility of a long-term trade agreement with the US. The US in the meanwhile says that they will announce a new location to sign the Phase 1 contract. So as of now, it is still in the air. There is no date, there is no place or location, and that is what the markets are taking cues in from. The other really has been the factory activity numbers that have come in from China, from Japan. They have continued to be on the weaker side. The Japan factory activity numbers are the lowest in 6 years, and when it comes to China, well, they have continued to decline for last 6 months as well. So the global growth concerns are back on, and that has led to buying when it comes to the gold prices. That is what we will start first with. The gold and silver prices are trading on the firmer note, and gold is headed for a second weekly gain. There is also decline in the US dollar, and that has been supportive. The US Fed has cut interest rates for a third time in this year, in this week itself. And we also are looking at the palladium prices holding around those all-time highs. So the strength really has pretty much continued in case of the precious metal prices. Joining us on Commodity Champions today is Kunal Shah from Nirmal Commodities. We also have with us Gnanasekar from CommTrendz. Gentlemen, thank you so much for joining us. Kunal, let's start with you first. And what has been your sense for the precious metal prices? Because we seem to be now stuck in a range. We've seen 1480 actually see a strong support. But on the higher side, 15, 20, 25 seems to be quite elusive as a target.
Yes, exactly. I think we are likely to trade in this range for some more time before gold prices actually shoots up. The problem right now is still there is a lot of change of stance by sometimes by China, sometimes by US, and that is basically resulting into further worry for the players. I think there is still a lot of uncertainty in the market how the long-term deal between US and China will take place. However, I remain optimistic about the prospects of the deal going forward. But I believe that right now it is very difficult to assess that it will happen immediately. So I think gold for the time being looks it should not go above 1530, 35, and like you rightly said, it should not go below 1480. So buy at dips is a strategy which I'll recommend for the next week. So 38,300, 350 good levels to go long for the upside target of 38,700, and stop loss should be placed below 38,000.
So 38,000, 38,500 are the kind of levels that you can see the gold price is trading within in a very recent term. Gnanasekar, what is your sense between gold and silver? Where do you see a better opportunity, and how are you looking at the silver prices also? Because we did see $18 per ounce come back.
Yeah, even silver I think has been moving in a broad range just like gold. But it's showing more traction compared to gold, in terms of the technical picture, as well as the readiness with which it's willing to move sharply higher compared to gold in terms of the overall move. So definitely, silver looks like something which could sort of relatively appreciate much more compared to gold even now, even though the ratios have sort of cooled down. Where it reached a peak of around 90 sometime back. Now it's cooled down significantly, but still there is a lot of catch-up that silver needs to do. So we still sort of overall bullish, even though there are chances of this trade deal going through that could sort of impact the overall complex to some extent. But we're still holding on to our bullish view that gold will test 1650 by December end, and silver close to $20 by that time. Though we see near-term volatility, I think the medium-term path is quite clear.
All right, so gains by the end of this year still on target. I'm assuming, Kunal, you have those targets as well. You've been bullish since we started this year, and you've been mentioning 1600. Are you reiterating those levels? And also for silver in the Indian markets, what are your strategies now?
See, we are not going to we are not going to see another 25-30% return for the year next year. But at the same time, I still remain optimistic, and I still feel that around 8 to 10% is very much on the cards. The fact is that there's going to be a further monetary debasement by most of the central bankers, may it be Europe, may it be Japan, may it be US. So these should increase the value of commodities such as gold. So every time we've seen in past, we've seen in history, every time there has been a monetary debasement by the central bankers, and we've seen the value of precious metal tends to move up. So my conservative target for the next year remains at $1650, and I believe that that seems very much achievable during the year 2020. So still bullish on gold and silver. Conservatively on MCX, I see it again trading at 51,000, 52,000 during the year 2020. So I believe that gold and silver both, the structural trend remains very much bullish, but at the same time it is not wise to expect returns like what we saw last year, 30-35, this year 30-35 return what we saw, that is not going to be repeated next year. So I think conservative 10 to 15% return is definitely on the cards.
All right, 10 to 15% gains in the next year, over and above what we have seen in this year already. Let's also move on then to the crude oil prices, because that has been a big talking point. On one side, it has been about the increase in supply from the non-OPEC area, where we have seen the US production at all-time highs of 12.4 million barrels. We also have seen the OPEC and Saudi Aramco output also come back on after those initial oil facility attacks that we had seen. And then the uncertainty about the global demand growth still just about continues. And that is the reason we have seen the crude oil price is also pretty much stuck in that range. 60, 62, we do see the Brent prices get there. But then every time we go there, it is not able to sustain those kind of levels. Kunal, what is your sense? We have been talking about the 4,000 mark on the Indian MCX prices, and that has been pretty elusive.
I think for crude, major trigger is going to come from OPEC. Like every year, from last 2 years, we are seeing OPEC is every year cutting production of more than 1.2, 1.3 million barrels, and cumulatively in last 2 years, OPEC has cut more than 2.5 million barrels of production, and hence after that also oil prices are not able to go above $60. So I think it requires more from OPEC, another 1.5 million barrel cut for them to bring up the prices. So I think they are going to do what is best in their interest, but at the same time one has to also look at what is happening in the US oil production, which is already at high of 12.35 million barrels per day. So in last 2 years, where OPEC has cut almost 2.5 million barrels of crude oil from the market, at the same time US production has increased by almost 2.4 million barrels. So I think it is quite balancing act. On one side OPEC production is going down, and on the other side US production is moving up. So I think if the US production remains the key for the year 2020, if US production growth remains muted for the next year, or it starts going down, then only price can really shoot up abruptly. I don't see that happening anytime soon. So I think for Brent, $65 is definitely going to be as good as $100. So maximum in any geopolitical news, you can see a spike till 65, but I don't think so it's going to sustain. On the downside, it should not go below 50. That is going to be the broader range. And from the trading perspective, I recommend to go long in crude oil at 3,800 for the upside target of 39.40, 39.50.
Okay, 3,800 to 3,950 kind of levels for the crude oil prices in India. Gnanasekar, what is your sense on the energy markets right now? And apart from your strategy on the crude oil prices for the near to medium term, what is your sense also for the natural gas prices? Because as winter approaches, this commodity as well starts moving.
Absolutely. Overall, the energy complex is going to be caught in a broad range going on from here, because you have the demand concerns which are lingering. And that's going to ensure that any rallies could be sort of short-lived and people would come to sell into that. But at the same time, at the lower levels, there is going to be a lot of support in terms of the overall winter demand which is approaching. At the same time, OPEC could again start cutting production if prices start going down. And like you rightly pointed out, the Saudi Aramco issue is also around the corner. And they wouldn't like prices to be around these levels. So these are possible supports that can sort of hold it from going below the recent lows of $50 in NYMEX and 56 or thereabouts in Brent. But the upside, definitely is a problem. There needs to be a lot of positive factors which needs to push it higher. So this is the broad range we're expecting. I think around 3,700 to 4,100 is a broad range by December. And as far as natural gas prices goes, there is quite some upside because the demand season is starting. But a lot will also depend on the weather forecast that's going to come and how prices move from here. But as prices stand right now, I think natural gas shows the potential that it can appreciate by at least 10 to 15% from present levels.
10 to 15% of gains in the natural gas prices also, and that really brings me to the metal prices. And this area for the longest time has been under pressure with US and China trade conversation going on for last 18 months and no progress in sight. Well, of course, we do see those conversations come in, but the back and forth is so much that at best the crude oil, the metal prices have been very, very volatile, but still yet again sticking to that range. Gnanasekar, what is your sense? Because we do see the individual fundamentals kind of improving. So copper, zinc, nickel have been some picks that we've been trading on the long side of. As we move ahead from here, what would you watch for and what commodities do you think can do better?
See, firstly, I think we should keep in mind that most of these negative factors that are still overwhelmingly putting pressure on base metals is sort of factored into the price. I'm not seeing a huge downside if suppose the deal gets postponed. I think the market will take the shock to some extent and it will again start moving higher only. So I'm not extremely bearish on metals from present levels. Clearly, there is a lot of potential for it to pick up from here rather than go down from here. Having said that, copper, like you rightly pointed out, the fundamentals are overwhelmingly positive. There's a huge deficit coming up in 2020. Maybe in 2021, this deficit can again become surplus, but next year, we're seeing deficits in many of the commodities, barring zinc and lead. So all the other three metals are going to be quite positive with this kind of a fundamental. And let's say if the trade deal does go through and there are some satisfactory things that happen, then we have a clear rally in hands in the next couple of months at least.
All right, so those are the metals to choose, and especially copper, of course, that really has been a favorite amongst various experts. This is another area that you could see buying coming in, not just this year, but the next year as well. With that, gentlemen, we'll have to take a short break, but when we come back, we will dwell some more on the metal prices and take a sense on where the agriculture as a space also is headed.